Hello, everyone. My name is Shosha-man. As you might have guessed from the title of this series, I am not a financial analyst, a fund manager, or a professional YouTuber. I am a veteran employee currently serving in my 30th year. At one of Japan's top 5 Sogo Shosha or general trading companies, my career began in the mid-1990s. This was the morning after for the Japanese economy. The euphoria of the bubble had already faded, and I joined the industry during the toughest early chapters of what we now call the lost decades. I personally lived through the era of the disintermediation theory, the widespread belief at the time that Sogo Shosha were becoming obsolete. The common wisdom was that we would soon be bypassed by manufacturers and technology, rendered unnecessary in a modern global economy. Every business magazine was questioning our very survival, calling us a dying breed. I saw the struggle, the massive restructuring, and finally, the radical transformation where we shifted our DNA from being simple commodity intermediaries to becoming sophisticated global investment machines. For a long time, international investors viewed the Sogo Shosha as a black box companies that were too diverse, too complex, and frankly too opaque to understand. Consequently, for years, our sector suffered from a significant conglomerate discount. Before Warren Buffett's Berkshire Hathaway entered the market, almost all of the 5 major trading houses were largely ignored by global capital. Their stock prices languished in what many called the value trap, with almost every firm trading at a price-to-book ratio of less than 1. But in August 2020, the landscape changed forever. Berkshire Hathaway announced a 5% stake in each of the 5 giants: Mitsubishi, Mitsui, Itochu, Sumitomo, and Marubeni. Today, those stakes have increased toward 10%. Why did the world's most famous value investor put billions of dollars into a sector the market had effectively abandoned? In this first episode, I'm going to use my 30 years of experience from the inside to explain the Buffett mystery and define what a Sogo Shosha actually is. To start, let's look at what the name actually means. Even for Japanese people, the term Sogo Shosha is a bit unique. It doesn't immediately explain the business model, but its literal meaning helps clarify the massive scope of our operations. Literally translated, Sogo means general or comprehensive. Sho refers to commerce or trading. Sha simply means company. So literally, it translates to a general trading company. However, the reality of what we do today has expanded far beyond this original name. While trading is in our title, we have evolved into a unique hybrid that doesn't have a direct equivalent in the West. We are part investment bank, part private equity, and part operator. Let me give you a real-world example from the front lines. In my 3 decades, I've worked on projects where we didn't just act as a broker for grain. We identified a growing demand across the region, so we went directly to the source. We invested in silos and inland grain elevators. We acquired or leased the logistics vessels to control the transport. We partnered with local farmers to stabilize the supply chain. And we integrated all of this with our own distribution and retail networks across Asian markets. We don't just trade the product for a fee. We own, optimize, and manage the entire value chain. Warren Buffett famously says he only invests in what he understands. At first glance, a Shosha managing hundreds, or in some cases, over 1,000 subsidiaries and affiliates looks impossible to grasp. However, Buffett saw something familiar. He saw a mini Berkshire, a conglomerate that generates massive, diversified cash flow from energy, metals, food, and machinery, and then reinvests that cash into new growth. He recognized that we are, in essence, Japan's largest and most diversified investment houses, but with a hands-on operational capability that most financial investors simply do not possess. Now let's look at what I call the secret sauce. This is the part I want to emphasize as an insider. As it is often misunderstood by those outside the industry, our investment logic is fundamentally different. From a typical private equity firm, we don't just look at a spreadsheet and decide to buy a company. We use a unique phased approach that leverages our trading roots. First, we almost always start with trade. We build a relationship by handling a company's raw materials or distributing their products. Now, don't get me wrong, of course. We conduct rigorous formal due diligence before any investment. We hire the best consultants and lawyers. However, for a Sogo Shosha, that DD is not just a snapshot. or a report provided by outsiders. Because we have already been doing business with the partner every day, we have a real-world due diligence that no spreadsheet can capture. We already know their operational bottlenecks. We understand their corporate culture, and we have tested their true reliability on the ground through years of trade. By the time we sit down at the investment committee, we often know the target company better than they know themselves. Only after establishing this deep trust do we invest. We might start with a minority stake, perhaps 5% or 10%. As we prove our value as a partner, we gradually increase our stake, turning the company into an equity method affiliate or a consolidated subsidiary. But here is the most important concept: trade merits. A traditional investor seeks two things: dividends and capital gains. A Sogo Shosha seeks a third pillar. When we invest in a company, we often secure the exclusive right to handle their logistics, supply their inputs, or distribute their outputs. This means the investment creates new trade, and that trade generates stable commissions and logistics profits. We earn from the investment's growth and from the increased trade volume. This double-dip revenue model creates a massive competitive moat and makes our cash flow incredibly resilient, even during market volatility. This is the synergy Buffett recognized: a self-reinforcing ecosystem of trade and capital. So, to summarize, Warren Buffett didn't just invest in Japanese traders. He invested in global asset managers with an operational boots-on-the-ground philosophy. He saw high dividend yields and low PE ratios in companies that were strategically positioned in the global supply chain, yet were trading below their book value due to the conglomerate discount. For a value investor, it was the ultimate hidden gem. Throughout this video series, I am going to take you deep into the mechanics of these five giants. We will look at each company's individual DNA, from the three diamonds of Mitsubishi to the consumer-driven power of Itochu. I will share stories from my 30 years, the successes, the failures, and the reality of being a Shosha-man that you won't find in an annual report. If you are an investor looking for a stable, high-yield, and strategically diversified addition to your portfolio, you cannot afford to ignore the Sogo Shosha. Thank you for watching this introduction to the Sogo Shosha world. But there is one big question we haven't answered yet. Out of all the companies in the world, why did Warren Buffett choose these five? In the next episode, we're going deep into the Berkshire breakthrough. I'll be breaking down the exact timeline of his investment, from the shocking announcement in 2020 to his recent visit to Japan. More importantly, from my perspective as an insider, I'll explain the hidden logic behind his multi-billion-dollar bet that the mainstream media often misses. Why Japan? Why the Shosha? And why now? If you found this insider perspective helpful, please hit the like button and subscribe to join me on this journey into the heart of Japanese business. Your support helps this channel reach more investors who want to understand the truth about Japan. See you in the next video.